Welcome to the SWIB Podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, producer of the podcast.
We are just past the midway point of 2024. Despite interest rates that remain high and inflation that is still above the Federal Reserve's 2% target, the U.S. stock market continues a bull run. Unemployment remains relatively low, and wage growth has been steady. So what does this all mean for investors, and what will the second half of the year bring as geopolitical issues continue to grab headlines and we head into a November presidential election? Today, we will talk with SWIB's head economist and Asset and Risk Allocation Chief Investment Officer Todd Mattina about what all these headline-grabbing issues mean for investors and the WRS. Todd will share his thoughts on the first half of 2024 and his perspective on what the economic outlook is for the remainder of the year.
The SWIB Podcast is a regular opportunity for you to learn more about the people and funds that comprise the Wisconsin retirement system. Please make sure you subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members, and leave us a review on Apple Podcasts so it's easier for other members to find this show.
Joining us today is Todd Mattina, SWIB's head economist and Asset and Risk Allocation Chief Investment Officer. Todd joined SWIB in 2023, bringing with him more than 20 years of experience in economic analysis and investments. Before joining SWIB, Todd was Senior Vice President, Chief Economist, and co-lead of the Multi-Asset Strategies team at Mackenzie Investments in Toronto. Prior to that, Todd was Vice President of Portfolio Construction, Chief Strategist, and Chief Economist at Investment Management Corporation of Ontario. Earlier in his career, Todd worked as a Deputy Division Chief at the International Monetary Fund in Washington, D.C. He has also worked as a Portfolio Manager at Canada Pension Plan Investment Board. Todd holds a PhD in Economics from Queen's University in Ontario. Todd, welcome. It's a pleasure to have you back on the SWIB Podcast.
Yeah, well, thanks for having me.
It's great to see you again, Todd. And, we had a really great conversation about a year ago here. We had you on for a mid-year update. We were talking about interest rates, the U.S. equity market, inflation, and the labor market. And here we are a year later, and those are still topics that are at the forefront of any discussion regarding the economy. But I think we can all agree that doesn't mean that there hasn't been news to discuss. So for starters here, catch us up. Can you give us a general sense of what we're seeing happening right now with the economy?
Sure, Dusty. Let me give you a quick summary of SWIB's mid-year update. The narrative's really been shifting, as you mentioned. So if we dial back a year ago, concerns amongst many economists and investors is that we were heading for a hard landing in the economy, that the Fed was keeping restrictive monetary policy through higher interest rates for longer, and that was going to weigh on the economy and create a major slowdown. 6 months ago, the narrative shifted again. We were now looking at an economy with strong, solid growth, rapid disinflation, and the expectation at the time was that the Fed would start cutting interest rates aggressively as inflation came down. Today, we're in a different position again. So we're in a position where growth looks solid, but inflation has come down more slowly, I think, than what many economists and investors had been hoping. And that meant that the Federal Reserve has not been able to cut interest rates as aggressively as the market had been expecting even 6 months ago. So this provides the context. You can see how the narrative has shifted dramatically in the space of even a year. If I look back at the U.S. economy in the first half of this year, we had some disappointments in the first quarter. When we look at the growth outcome at the quarterly level in the first half of this year, we saw consumer spending was weaker than expected, and we had some negative effects from trade and inventory effects. But we're still expecting for the year as a whole to see economic growth in the U.S. somewhere in the range of 2.25% to 2.5%. And that's a pretty solid, healthy rate of economic growth. In fact, it's well above what you would consider for the U.S. as being its sort of non-inflationary, sustainable, or potential rate of economic growth. If I turn to inflation, we still expect to see inflation decline, but perhaps gradually. So we see inflation for the year coming in around 3% and then falling to about 2.5% in 2025. Now, this is good news. It's good to see inflation continuing to follow that disinflation path, although because it's been more gradual than many had expected, say, even 6 months ago, it's not enough to allow the Fed to aggressively cut interest rates as markets had been discounting back in January. Of course, another big theme for the year are geopolitical and election uncertainties. That ranges everything from the potential for U.S.-China trade tensions, conflicts broadening out in the Middle East and Russia's war in Ukraine. And of course, the major impact of major elections, both here in the US, but also internationally. And that creates uncertainty for investors. But we're now in a position after the first half of the year where major elections are done in India, the UK, and France. So all eyes are shifting now to here in the US and the big election in November. This policy uncertainty could affect a number of major policies, everything from fiscal policy and tax policy to immigration. And all of that has important effects on financial markets. Now, given the economic backdrop and these geopolitical uncertainties, financial markets, particularly the overvalued U.S. stock market, are facing headwinds in the second half of the year. We've seen over a 15% year-to-date rally in U.S. stocks, and that's been driven largely by a handful of companies, a handful of securities, affectionately described the Magnificent Seven. This is just a handful of big tech and chip-producing stocks, some of which have just recently become household names like NVIDIA. Now, given the already high valuations for these small group of companies that have been driving the overall market, sustaining the market rally is going to depend, I think, on achieving very strong rates of earnings growth in the second half and beyond to validate the enthusiasm we're seeing for the AI revolution. Any earnings disappointments could lead to some downside market volatilities in the second half of the year or even beyond. And then just to wrap up with the fixed income market, credit spreads are looking low by historical standards, but they continue to be fairly supported by the ongoing low chance of a recession here in the US. And of course, the Fed, which is expected to start cutting rates in the second half of the year. So that also continues to support credit markets.
So there's a lot to unpack there, Todd. So let's dive a little deeper into each of those areas if we can. Maybe we could start with your thoughts on growth and inflation.
Sure. Let me start on the growth side. So since 2023, the U.S. economy has outperformed other major global economies. Last year, the Eurozone printed a pretty meager, less than 0.5% rate of economic growth. China's economic growth in 2022 and 2023 were among the lowest rates in decades outside of the pandemic. While in contrast, here in the US, economic growth has been 2% or better in recent periods, driven by strong household spending, what I would describe as a hangover of excessive fiscal stimulus during the pandemic, and then, of course, solid wage and income gains given the hot labor market. Looking ahead, we expect these economic divergences across the major economies to start narrowing. So as the U.S. economy and the labor market cool here, we could see economic growth, which this year, as I mentioned, projected somewhere in the neighborhood of 2.25% to 2.5%, to start slowing going into 2025. So this year, growth is still well above its long-term non-inflationary potential rate. But as we head into 2025, as the economy starts to slow and lose some of that momentum, we see it normalizing to somewhere in the neighborhood of 1.8%, which is in line with its long-term potential rate. And that should also coincide with monetary policy, which is currently pretty restrictive with these high interest rates starting to ease as inflation continues to fall, and that'll help stabilize consumer spending. Now, while U.S. growth moderates, other major economies around the world are either bottoming out or showing signs of picking up. So we see that narrowing in some of the divergences across major economies. The Eurozone is seeing some improvements in the services and net export sectors, and growth is expected to double in 2025 and 2026 to something just under 1.5%. So a much stronger performance for the Eurozone. And that will be supported by a stronger consumption there as well. Even China this year is experiencing stronger consumption and trade than many economists have been expecting. If you look at the International Monetary Fund's mid-year update just recently published, these trends, as they mentioned, really indicate a convergence of major economies towards their long-term growth potential, which is kind of a not too hot, not too cold outcome, which would be a kind of a happy equilibrium for us to be in.
So what are some of the reasons SWIB's outlook is for a slowing U.S. economy?
Sure. So both the U.S. and global economies are normalizing, I'd say, towards a more sustainable pace of economic growth after this kind of exceptional period we've had since the pandemic. If I start with the U.S., economic activity surprised to the downside in the first quarter of this year, in particular, with lower than expected consumer spending, lower trade, and some inventory effects. And what's been driving that, I would say, are households have built up what many economists would describe as excess savings during the pandemic years. And that provided households with a buffer that supported higher spending. Now, economist estimates suggest now that some of those excess savings, particularly among lower income households, have been eroded by both higher rates of spending recently and the effects of high inflation. Now, persistently high interest rates from the Federal Reserve's tight monetary policy have also played a restrictive role, which is starting potentially to start finally weighing on U.S. economic growth rates. As inflation continues declining, there's an interesting paradox that so-called real interest rates, that's the interest rate after you take account of inflation, will actually get even more restrictive unless the Federal Reserve starts cutting interest rates. So just to sort of keep policy on a similar level of restrictiveness, the Fed has to start cutting interest rates as inflation comes down. We look at other indicators. Labor market indicators are also pointing to some slowing U.S. economic growth. The recent employment reports have been a little on the soft side. And what's been especially notable is the higher unemployment rate that ticked up to just over 4% in June. Now, while a 4% unemployment rate is pretty low relative to history, it is significantly higher than this cycle's low, which was about 3.4% back in April of last year. And that was an over 50-year low for the U.S. So really corresponding to that really tight labor market we've been experiencing here in the U.S. But the issue is that historically, when you see a large increase in the unemployment rate from its cycle low, that's usually been a pretty reliable predictor, historically speaking, of an economic slowdown. So when you put those warning indicators together from the labor market, some other leading economic indicators that point to a slowdown, it does point to some slowing momentum in U.S. economic growth in the second half of this year and beyond. But we also have some offsetting factors that sort of offset those more bearish or negative effects. Some of the headwinds that we had in the first half of this year, or at least in the first quarter of this year, like negative trade and inventory effects, are expected to be persistent. And then we still expect some solid consumer spending supported by wage gains. And of course, the Fed's interest rate cutting cycle, which many expect to start in September.
So, Todd, I know that we often hear the U.S. economy referred to as a train, and in this analogy, interest rates are the brakes, right? And certainly it seems like the Federal Reserve has been leaning on the brakes a little bit harder and longer than most people expected them to when they started this process. The Reserve seems to be taking a higher for longer stance on those interest rates. Why is that? And when might inflation get back to the Fed's 2% target rate?
Yeah, thanks, Dusty. That's a great analogy. And it's true. This interest rate cycle, we've seen tighter monetary policy for longer. There's been a number of surprises. Many economists had expected a hard landing in the economy, as it is to slow down a moving train, to use the analogy. Takes a lot of restrictive policy, and often that leads to a full stop in the train, to continue the analogy. We haven't seen that this time. We've actually seen something different, where we've had quite restrictive interest rates, but we've seen the economy plow along with very solid, even above long-term potential growth rates. So these higher for longer interest rates, while restrictive, weren't as restrictive as many people feared. So if we look back, just 6 months ago, markets were anticipating as much as 6 Fed rate cuts this year. And that was, back in January, looking ahead, we saw an economy that looked to have solid growth, potentially a slowdown due to the high effects of interest rates, but rapid disinflation, which means an inflation rate that would be falling more rapidly than what it turned out to do. We've seen inflation fall, but it kind of hit a plateau, so to speak, where getting further declines in inflation have proved to be harder than what many people expected. And another way to describe this is that inflation rates can be sticky. And that can come from the fact that things like service sector prices tend to move slowly. And more than that, they're driven by labor costs. And we've seen wage rates and the cost of labor go up quite a bit. So that's causing the rate of inflation to decline a little bit more slowly than people had hoped. But, inflation peaked back in 2022 at 9% annualized rate. So we've gone from a 9% inflation rate peak to something that looks more like in the 3% range for 2024. So as I was saying, that get this continued gradual pace of disinflation towards the Fed's 2% target is going to require some more action on what economists describe as core services. That's basically the service sector, excluding the cost of shelter or housing. That takes a little bit more time. That can be stickier because of the high wage costs that are embedded in the cost of producing services. And as we all know, the labor market's been hot and wages have been high. Wage growth has been high. So getting progress on getting core services down will be an important part of the Fed's job to have success in getting inflation to the 2% level. The Fed's been lucky, we all have, in getting inflation down because the goods sector has had rapid declines in prices. We saw goods prices that were quite high and goods inflation was quite high during the pandemic years, during the lockdown, as the pattern of consumer spending really shifted towards goods and away from services. We couldn't go to restaurants, we couldn't travel, we couldn't consume services like we normally do. So there was a surge in goods sector demand, which really drove those prices. And as the pattern of consumer spending shifted after the pandemic ended and the lockdowns ended, we've seen service prices back under pressure while goods prices fell a lot. The latest inflation report for June showed some promising signs with monthly and 3-month average rates moving lower. And we're seeing increasing market expectations for at least 2 Fed rate cuts this year, possibly starting in September on the back of declining inflation rates, which will give the Federal Reserve that room to start easing monetary policy. But the Fed chairman, Jay Powell, emphasized the need for the Fed to get increasing or greater confirmation from incoming economic data before the Fed could feel really comfortable cutting interest rates more aggressively.
Well, certainly. And, I'm kind of a news junkie, Todd. And when I turn on the news, I think it's a sign of decreasing volatility, just the fact that I hear the economy mentioned a whole lot less than we heard even a year ago here. But one thing that we do still hear on the news a lot is everything that's going on around the world right now. Now, you mentioned heightened geopolitical risks this year being an economic factor yet again. Can you elaborate on those risks and how those are affecting the economic and market outlooks?
Yeah, sure. No, it's definitely been a theme in 2024, a sort of heightened geopolitical risks and uncertainty from elections, not just in the US, but internationally. That's been an important source of uncertainty for investors, wondering what the outcome of those events could be. And I would say that, generally speaking, geopolitical events typically don't have a lasting impact on long-term returns and risk, even though it gets a lot of attention in the short run. The U.S. stock market, for example, has historically gained on average under both Democratic and Republican administrations in the White House. And market performance in the long term is influenced by many factors beyond just whoever sits in the White House. Factors like economic policies, global events, technological advancements, consumer behavior, just to name a few. So despite differing economic agendas with whoever might be in the current administration, the market as a whole has proven rather resilient to these different changes, even if there could be individual sector or industry winners and losers at the sort of bottom-up level. The overall market tends to be fairly resilient. Now, that said, geopolitical events and elections, referendums, and so on can and often do heighten short-term market volatility as investors sell their riskier assets in a crisis period or a period of heightened uncertainty to seek more defensive, safe haven type of assets. But we have to be careful. Most investors simply don't have an edge in consistently forecasting the outcome of political events or even the short-term asset price responses to those events. You need to get both forecasts right. What's the outcome of the event and how do financial markets respond to the outcome of that event? This is a very tricky thing to get right consistently and reliably. And I would argue that most investors don't really have an edge in that space. Today, the major geopolitical risk events are, as we were mentioning earlier, potential regional spillovers from Russia's war in Ukraine, the conflict in Gaza and the Middle East potentially broadening out, or a crisis with China over Taiwan or disputed Pacific territories. So there's plenty of geopolitical uncertainty out there that could potentially affect markets. But when I look at election uncertainty, most of international election uncertainty is now behind us after the first half of the year. We had major elections in India, the UK, and France, and much of that uncertainty is now resolving. So all eyes are now shifting to the US with the major election here, of course, in November. Now, that outcome could affect a variety of economic policies, immigration, security, and other policies. And as I would argue that I think the key is diversification. There could be individual companies, industries, or sectors of the economies that are winners or losers, but forecasting those is exceptionally difficult. So from an investor's perspective, it's important to stay diversified across these risks, across these potential winners and losers. look for concentrations you may have to any particular outcome. And just, remember this underscores the power of diversification and a well-balanced asset allocation.
So, Todd, let's switch gears a bit, talk about the Fed and the markets. U.S. stocks have posted an impressive rally so far in 2024. For example, the S&P had one of its best first-half performances during an election year since 1976. So the big question then, will the stock market rally continue?
Yeah, it's, of course, a key question for investors. U.S. equities, as you mentioned, have rallied sharply year to date, over 15%. And that's despite this higher for longer Fed interest rate policy. The U.S. equity market, however, remains pretty lopsided in terms of what has been leading the advance. If we look at the S&P 500 index of the largest publicly traded U.S. stocks, just 7 stocks account for about 30% of the total market capitalization or the total value of the market, which is pretty extraordinary. It's rare to see these periods, not unprecedented, but rare to see periods when just a handful of large stocks really dominate the whole market. The last time there was this kind of comparable concentration was during the tech bubble in the late 1990s and early 2000s. And, we also saw, I would say, themes like this lead to concentration during like pre-2008 when the housing boom was a big driver of economic activity and what we saw in some markets. But interestingly, if we look back in history at other periods when we saw market concentration like today, it doesn't necessarily imply a period of stock market declines. We've experienced episodes when enthusiasm and a hot theme led to future disappointment, like the dot-com technology bubble, like the housing market when it popped in 2006-07. But really, the outcome of today's enthusiasm really depends heavily on whether the AI revolution will be sustainable. That's been a key factor driving a lot of the market's enthusiasm for big tech and chip-related stocks like NVIDIA. Now, based on already rich market valuations, these 7 or 8 stocks, which have been driving overall stock market activity in the rally year to date, really to validate that valuation, we need to see very strong earnings growth by these names in the coming quarters and years, for that matter, to sustain even current valuations. That's going to be a challenge, and it's going to become an increasing challenge as we go deeper into the year, into later quarters where the base effects become harder. There were some great earnings surprises in these names last year, but those are already kind of baked in now. And as we go further, we're going to need to see continuing and ongoing positive earnings of that magnitude to sustain a rally like this. Now, supporting the rally, there are some factors that would support the ongoing rally, and that includes the fact that we have a low chance of a recession in the U.S. on the current horizon. We see continuing disinflation, and that's going to allow the Fed space to begin normalizing its restrictive monetary policy, start cutting interest rates, and that's historically been a positive factor for the stock market. So there are also some positive factors there. So all in all, it suggests that we're likely to see much less strength in the U.S. stock market rally from here. We should see that momentum starting to ease off, and a lot more hard work that needs to be done in sort of justifying these valuations with some strong earnings growth.
Well, Todd, given those corporate earnings estimates, the uncertainty around potential Fed rate cuts, November's presidential election, you have here cited the tech bubble and 2008, which makes the hair on the back of my neck stand up here. But given all of these X factors, would you say that the U.S. stock market is vulnerable to a correction in the second half of the year here?
Well, I mean, that is the trillion-dollar question, but I have to say timing stock market corrections, just like forecasting recessions, is very challenging business. I mean, few investors or economists can consistently get that precise timing right. Now, that said, as I was mentioning, I wouldn't expect this very impressive pace, this very strong and sharp U.S. stock market rally to continue at this pace through the remainder of 2024. But with solid growth backdrop, with the Fed starting to move to cut interest rates, we could see the stock market rally broaden out to the rest of the large cap market index. We already saw some hints of that earlier in July. Also supporting that is the fact that the rest of the index, their valuations for those sectors and industries, more cyclical names, more interest rate sensitive corporate names, look much cheaper than the 7 or 8 names that have been driving the overall stock market. So the valuations are also supportive to see leadership of the stock market rally from here start to broaden out.
So, Todd, finally, let's talk about the labor market. The labor market remains healthy despite payroll gains slowing a bit in the first quarter of the year. As you mentioned earlier, the unemployment rate edged up just above 4%. What are your thoughts? What do you think we will see in terms of the labor market in the second half of the year?
Yeah, recent employment reports have been a little bit of a mixed bag, which have been sending mixed signals to investors. The unemployment rate is low. It's just above 4%. And payrolls were slightly higher than expected. But other labor market data show that quit rates, weekly hours, job openings have declined, indicating maybe a less tight labor market than we've been accustomed to seeing in the last year or two. The June employment report was soft in other notable ways. So the unemployment rate of 4.1% was low, but as we were discussing earlier, it's increased significantly from the cycle low of 3.4%. And historically, a rise in the average unemployment rate by a half percentage point from that cycle low has been a pretty reliable forecaster of future economic slowdowns. We've also seen some downward revisions to payroll gains in the previous months. Wage and salary growth have moderated, and that's good news on the inflation front, but it could also be indicative of the economy losing some of that strong momentum. Recent developments, though, in the labor market are a little harder to interpret than usual because we have seen a higher unemployment rate, but that may not necessarily 100% reflect a weakening cyclical backdrop in the economy. It could also reflect the labor supply. We've seen an increase in the labor supply, which means more people looking for work, and that could just be putting some upward pressure on the unemployment rate. But all in all, a higher unemployment rate remains a bit of a warning signal when you see economic activity also slowing. So we need to keep a close eye on the leading economic indicators in case they start flashing brighter red on top of an unemployment rate that we don't want to see it get any higher. But overall, the outlook for the labor market in the second half of 2024 really mirrors the outlook for the overall U.S. economy, with just losing some steam, but still remaining solid and strong overall.
Todd, one of the jobs that Chris and I have when we produce this podcast is we get it all ready and we put it out there, but then we have to write a headline that's at the top that determines whether or not people are going to listen to it. And we have to find some sort of key takeaway from the insights that we've put forward. And if I'm looking for a key takeaway, a headline from the discussion that we've had over the last 30 minutes here, it's that we are cautiously uncertain about the short-term outlook of the economy here. For what it's worth, cautiously uncertain? Do you think that kind of sums it up right there?
Yeah, I think economists are always cautiously uncertain because they can see the range of the famous Economist quip that we are on the one hand and then on the other hand. So we're always a little cautiously optimistic or cautiously forecasting. If I had to have a single tagline to describe it, I would say not too hot, not too cold. We're in an environment where growth should be solid, but not red hot, but also not a hard landing. Inflation, not too hot, not too cold. It's gradually coming down, gradually disinflating. It's going to allow the Fed to reduce these interest rates gradually. So it's kind of a steady as she goes kind of environment where, it's quite different than what economists were expecting, say 6 months ago, where we were expecting just an aggressive pace of Fed rate cuts, 6 this year. Now we're looking at possibly 2, a slower pace of economic growth this year, but still very solid, very strong. So it's kind of a not too hot, not too cold environment.
So that's all the short-term outlook, but what about the long-term outlook? Where are we sitting when we look on that long-term horizon?
Yeah, I mean, of course, this is a critical question for SWIB as managing the WRS. Our natural investment horizon is very long. We want to fund long-term pension benefits for generations to come. So when we're investing the assets of the WRS, our investment horizon is a very long-term horizon. So this is absolutely the right question to be asking is, what is the long-term investment outlook? So in terms of expected returns, you can think about the risk-return frontier. And what I mean by that is generally when you take more risk, you're compensated by having a higher expected return. And ideally, what you want to see is as you take more risk, you get compensated with a significantly higher extra expected return versus safer assets. That's to reward investors for taking on extra risk. So let's think about that. So there's 2 horizons. You can think about what that risk return frontier looks like over the next 10 years, the next decade, or an even longer period, which is probably even more appropriate for a pension plan like the WRS, say a 30-year outlook. Now, starting with the 10-year outlook, expected returns suggest that the reward for taking additional risk certainly in 2023 has been weaker than we saw in 2022 or 2021. And that means that risk return frontier is getting flatter. And the reason simply is that we've seen a very sharp and abrupt increase in cash interest rates. And cash rates are a defensive, risk-free, think of treasury T-bills, like very safe assets that are offering very high returns relative to history, relative to what we've seen in the last 10 plus years. So as cash rates have increased very abruptly on the more defensive side of the risk return frontier, the extra return you get for investing in riskier assets like equities, credit, even treasury bonds doesn't look as attractive as it did even a few years ago when cash interest rates were much, much lower. With that risk return frontier flattening, we have to be mindful of our risk return balance. Starting valuations for public equities are much richer today, driven by the Magnificent Seven, about those 7 or 8 big tech names and chip producing stocks, as we discussed earlier. And historically, high starting valuations have fairly reliably forecast lower long run average returns going forward. And I think that's what we're seeing when we focus on a 10-year outlook. So overcoming today's rich starting valuations really require further increase in corporate profit margins, which is going to be the hard work of sustaining high profits going forward, which are already sitting on the high end relative to history. Overall, the expected return in the next decade for, say, a typically balanced portfolio of equities and fixed income is likely to be lower in the next decade than we've seen in the recent past. So, for example, a 60-40 portfolio of global public equities and, say, U.S. fixed income has an average expected return in the neighborhood of about, I'm going to call it 6.25%, which is still a healthy expected return. But if I turn to the 30-year outlook, that's where some of these valuation effects, which look less attractive in, say, the next 10 years, start to dissipate. And you get more of sort of the long-run expected return and risk of these asset classes. And that, again, really aligns better with the outlook that we focus on here at SWIB in managing the WRS, where we think about that 30-year and even beyond horizon. So there we expect to see cash rates fall, led by the Federal Reserve starting to cut interest rates as inflation moderates. And that's going to allow investors to start anticipating a higher expected reward in some of the riskier asset classes on the frontier. So we'll see what you would typically normally see in a more stable situation where cash rates are low, treasury yields are higher, yields on corporate debt or corporate credit are higher still, then followed by public stocks and then ultimately private equity. So over the longer run, we would expect to see that sort of steeper risk return frontier come back into place, providing a healthier long run expected return for pension plans with long horizons such as ourselves. So you might see that 60-40 portfolio of stocks and bonds look like it yields something more in the 7% or higher range, more in line with history.
So, Todd, what role does high government debt play in terms of long-term interest rates and future spending?
Yeah, it's an important question. U.S. Treasuries are vital. They provide a liquid, stable store of value and serve really as a benchmark for the pricing of other fixed income and other asset classes. They're also crucial for the institutional funding and balance sheet management, sometimes called the plumbing of the financial system. The value of treasuries depends, though, on investor confidence and the government's ability to repay that debt over the long term. In the 1990s, we had the so-called bond market vigilantes who came out and penalized governments around the world when they perceived that they were running unsustainable borrowing. James Carville, a U.S. political strategist, famously quipped that he'd like to come back as the bond market because it could intimidate everyone. And that was certainly the feeling back in the 1990s. But the bond market vigilantes have been largely quiet in recent decades due to the very low interest rate environment compared to the rates of economic growth. So if you looked at interest rates, they were relatively low relative to growth rates. And that really helped keep long-term government debt ratios on a sustainable long-term footing. But concerns about the sustainability of government debt could always resurface if government credibility starts to wane and starts to be questioned again under the weight of much higher interest rates. Now, the deteriorating health of U.S. public finances, therefore a growing financial risk. Debt surged during the pandemic, understandably, to help stabilize the economy and support people in need. But we now are in this position of having a very high level of debt And if you look at CBO projections, for example, we expect to see very high levels of ongoing budget deficits for the next 10 years, which will continue to add to that debt and add to funding pressures. High debt and deficits reduce a government's capacity to handle future economic or financial shocks. And it could put pressure on institutional funding markets in a more extreme scenario. Now, alarmingly, to me at least, addressing today's high budget deficits and the public debt has kind of faded away from the public policy discussions. If you recall, for those of us old enough, back in the 1990s, reducing budget deficits, intergenerational equity, dealing with high debt, which was actually much lower at the time, was a major policy concern, even at those low debt levels. And today we are substantially higher. U.S. government debt is now more than 100% of GDP, or the size of the economy. So for long-term investors, I think the main risk from the current situation in the Treasury market is that uncertainty eventually creeps in about the government's credibility in eventually getting the Treasury market back on a long-term sustainable footing. And that could put some pressure on long-term interest rates due to what is often called term premiums, which basically are a sovereign risk premium. And that could potentially dent the fair value of other asset classes because remember, treasuries are really the bedrock or the cornerstone of the overall financial system in setting the so-called risk-free interest rates. So if the most safe asset is suddenly looking riskier, that could have knock-on effects on other asset classes. So this is only a risk, but as a long-term investor, thinking about long-term risks and expected returns, the health of the treasury market is something that we want to keep monitoring and keep an eye on.
And so long-term, what does all this mean then for the WRS?
So the WRS, its long-term objective is to achieve a long-run rate of return of about 6.8% currently. That is required to keep the system stable financially, fully funded, as it has been for many years, and to provide an appropriate amount of dividend increase for our beneficiaries. And you can see with the 30-year outlook that I was describing, the position of the WRS remains strong. We start from a fully funded position. Our asset allocation, it's not a 60-40. I was describing a simpler sort of traditional benchmark that people will often look at, but our asset allocation has an expected return over 30 years that should comfortably meet the 6.8% hurdle. So we are, I believe, in a strong position to maintain our fully funded status and provide that appropriate level of dividends over the long term.
Well, Todd, during eventful times, it certainly gets really easy to focus solely on the short term and lose sight of that long-term horizon. Certainly it feels like these are eventful times. That might be an understatement here. But we've just been looking at the next quarter and the next interest rate adjustment for a while here. This has been a great reminder that SWIB and the WRS are long-term investors with a generational approach to investing on members' behalf. So, Todd, this has been a great discussion. Thank you so much for joining us here on the podcast.
Thank you so much.
And thank you to all our listeners for checking out this episode of the SWIB Podcast.
The SWIB Podcast is brought to you by the State of Wisconsin Investment Board with editing by Matt Covarrubias and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.